any branch that you have opened up, any branch, in any branch you have opened up an account, all your banking transactions or all your banking functions can be performed only through that branch. But today you need not go to your own branch bank, you can go to any branch, because all the banks are connected with something called as network connectivity. So all the bank branches have the connected information. So if a customer wants to get any kind of service done, whether it is deposit of money, taking of loans, or whether it is payments, anything, because all banks are connected through a centralized record keeping system, they allow access from any location. So today you need not go only to the branch with which you have opened up an account, you can visit any branch, right, in order to perform your banking operations. Not only that, today technology has enabled the banks to provide something called as an e-banking facility also. E-banking facility is nothing but an internet banking, online banking, or net banking facility, which is allowed to the customers to use banking services over the internet. Right? Customers need not visit the office branches, or customers need not go to the bank or branch. With the registered customer ID and password, they can log into their banking account using an internet, and from there, right, they can perform all the functions, banking functions, like taking an account statement, opening up a fixed deposit account, paying utility bills, any kind of request for checkbook, any recharge for mobile phones or your DTH, everything can be done 24 by 7, sitting at your doorstep or sitting at your ease of convenience. You can carry out anything. Not only that, the technology enabled services have also enabled banks to perform something called as NEFTs, which is called as NEFT, right? Which stands for National Electronic Fund Transfers. It is a nationwide payment system that allows the transfer of funds from one bank account to another bank account. That is, it is a most popular way of transferring funds from one account to other account electronically, right? And this happens in a phased wise manner, or this happens at equal time windows, right? You have to go to a bank for this purpose, right, from where you can transfer your funds from one bank account to another bank account, right, which can involve smaller amounts, bigger amounts, whatever is the limit. According to that, you can transfer funds from one bank account to another bank account. There is something called as real-time gross settlement payment systems. This is also a fund transfer mechanism. There, in NEFT, funds are transferred in batches, or funds are transferred at equal time intervals. But in real-time gross settlement systems, funds are transferred instantly or immediately. Once the transaction is completed, the payment will be received immediately. So, for example, whatever mobile transfers, Google Pays or Phone Pays that we make, they come under RTGS. The payments will be made immediately, right? But there is a what do you call as a limit, upper limit and lower limit, according to which the payment can be done. Apart from that, if you are going to bank and making an immediate transfer system, we call it as real-time gross settlement systems. But if you are making the payments using what do you call as mobile phones, we use something called as IMPS, immediate payment services, right? This is a money transfer mechanism which is made available by the Reserve Bank of India. This also transfers funds instantly in case of emergencies. This is the most convenient and the most widely used technique for fund transfers. Next comes your electronic clearance services. These are also an alternative method which is provided for making or payment or for paying the transactions like interest, pension, right, salaries, dividends, right? It's like a payment system which makes the payments periodically over a period of time, right? Then whenever we are talking about ECS, that is electronic clearance services, right, this scheme provides, right, for making the payments periodically, which might include anything, right, from payment of pension, payment of commission, payment of dividend, payment of interest, payment of refunds, anything is possible. Apart from that, in technology driven services, we have something called as debit cards and credit cards. Now, whenever we are talking about debit and credit cards, these are the plastic cards which are used, right, in order to make instant debit based or credit based transactions. Debit card can be only used when you have sufficient amount or sufficient sum in your bank account, whereas credit cards are instant credit based transactions. Right? These cards are linked to your bank account. So whenever you make payments, any kind of payments at POS centers, right, your amount is immediately debited with the respective amount if it is a debit card, and if it is a credit card, it creates a credit facility available, right, which has to be paid at the end of a specified period. Now, apart from that, we have something called as POS terminals. These are called as point of sale services, which is a hardware system for processing the debit or credit card payments at any retail stores or at any what do you call as malls or bank terminals. Now, this is an electronic tool at retail stores, right, which helps in credit card payments. This machine accepts and processes the cardholder's payment, right? Where you can use a debit or credit card at the POS center in order to make the fund transfers. This is about technology driven services. Now, when it comes to who regulates the banking system in India, see, whenever we are talking about the regulation of banking services in India, the central bank, which is called as the Reserve Bank of India, is the primary regulator of banking activities or banking transactions. They they give you a Reserve Bank of India has a wide range of powers to regulate the Indian financial sector, and especially the banks, whether you are talking about public sector banks, whether you are talking about private sector banks, or whether you are talking about foreign banks. Every bank is working under the close supervision of, or every bank is working under the close clutches of Reserve Bank of India, right? Now, Reserve Bank of India issues timely guidelines. Reserve Bank of India issues what do you call as notifications about the functioning of all the banks in India. So it is a regulatory body, right, which takes into consideration corporate governance, prudential norms, and the conditions for structuring banking products and services, which is very, very important. But today, there are a lot of challenges which are faced by what do you call as banking services. One of the biggest challenge that is thrown at the banking services is digital influence. Because of the huge digital literacy or because of huge digital usage, it has become a big challenge to the banking sector about that illiterate uh, sector which cannot understand. There is lack of literacy among financial products and services, right, about the usage of things that which is giving rise to a lot of cyber crimes, right? That is one of the biggest challenge. And uh, in the provision of credit from online apps or what do you call as shadow markets is also throwing a biggest challenge with the banking sector, and customers not being paying the amount on time, non-performing assets are also throwing out biggest challenges in banking sector. So all these are the biggest challenges that banking sector are facing these days. Now, apart from that, we have something called as insurance services, right? I told you insurance is also one of the sector which is gaining importance these days. Insurance is also one of the sector which is becoming prudent these days. Now, when it comes to insurance, see, the world in which we are living is full of uncertainties, right? Is full of risk, right? Everything is exposed to different levels or different kinds of risk. Every day when we come out of our house, there is no guarantee that we will reach our home safely, because there are a lot of risk associated with one person's life, assets, properties. So it is not always possible to prevent unwanted or risk. So what happens is you have to look out for methodologies, you have to look out for techniques in order to reduce the risk. So insurance is one of the risk management technique that we use in order to reduce or eliminate the risk caused by different uncertainties. Now, here comes the question, what is insurance? Insurance is like any other contract between two parties in which one party called as insured, the person who takes the insurance on his name is called as insured, or the person on whose name insurance is taken, he is called as the insured. And there is another party called as insurer. Insurer is the insurance company which provides insurance. Now, insured is the person whose life or property is protected or insured with the insurer. That is, whose risks are covered, whose risks are insured, such person is called as insured. And insurer is the insurance company who will transfer, who on whose name the risk will be transferred. Such kind of company is called as insured. Now, what is insurance? Insurance is a contract between insurer and insured in which insurance company promises to indemnify. Indemnify is nothing but protect you against the losses that happen because of happening of an event. See, if some unforeseen situation happen, if some unforeseen incident takes place, in that case, the insurance company promises to protect you from all kind of financial losses that you suffer based upon the insurance policy that you are taking, right? So it is an arrangement, right, by which a loss which is caused by some unforeseen situation or by some uncertainty is spread over a large number of people instead of an individual taking out it by on its own name. So there is a document, there is an agreement, right? Insurance is a contract, right? It is an agreement or it is a document which contains all the terms and conditions of the insurance. This document is called as an insurance policy, right? And every insurance policy has something called as sum assured. Now, what is this sum assured is how much amount of policy are you taking on your name, or how much amount of insurance are you taking on your name, that is called as sum assured. And because your life is protected or because your loss is protected under insurance contract, you have to pay, right, a consideration in return. That consideration is called as insurance premium. Now, if the what happens in insurance is the insured pays the premium periodically to the insurer. For that, in return, insurer, when some unforeseen situation happens, he promises to protect you from that loss which will occur because of that unforeseen situation. Now, this premium can be paid in any manner. It can be paid in monthly, yearly, half yearly, quarterly manner. But whenever there is an unforeseen situation, the insurance company will promises you to indemnify or repay all your insurances. Now, whenever we are talking about insurances, there are two major functions that an insurance does. These two functions are divided into two types. You have something called as primary functions of insurance, and you have something called as secondary functions of insurance. Now, what are the primary functions of insurance are? Insurance provides certainty. See, before the happening of an incident, what is your financial position? The insurance promises you to put you under the same certainty even after the unforeseen situation. See, for example, your car worth is 4,50,000. If a car meets with an accident, which is an unforeseen situation or which is an undetermined situation, in that case, the insurance company promises to replace the value of your car of the damage that is caused. So it provides you guarantee, it provides you certainty up to the extent of, right, premium that you are paying or up to the extent of some insurance that you are taking. Not only that, insurance provides you protection. The main reason or the main function of insurance is to provide you protection against all the losses. The time and amount of losses are uncertain. So insurance company promises you to protect against all the losses, right, up to the amount or up to the sum that is insured in your insurance contract. Now, what happens in insurance is your risk you are sharing with a large number of people. See, it for an individual taking up for taking up the sum or for the taking up the risk is very high. So this risk is shared among a large number of people who are exposed to the same amount of risk. So insurance is a risk management technique or insurance is a risk sharing technique. Not only that, insurance provides other services, other functions also. There's some secondary functions that insurance provide you. Insurance results in providing capital. See, it is also viewed as an investment avenue. Insurance is also viewed as an investment avenue. What are you doing under investment? You are putting your money in some instrument which gives you return or which gives you interest somewhere. So insurance can also be treated as an investment option, or insurance can also be treated as a capital option. It helps in capital formation in the economy. Insurance improves efficiency. See, what if you're taking up a life insurance policy, you are eliminating all the worries, you are eliminating all the miseries of your loss, death, or what do you call as a destruction of property. So because you are protected against your losses, because you're protected against your destruction of property, people can focus on other goals. This will help a person's efficiency. This will help in improving a person's efficiency. So it will not only help you in capital formation, it will also help you in improving your efficiency. Not only that, it helps in economic progress. Insurance policy helps in economic development of a country. There is an importance, there is a significance of insurance in the in protecting the life of the people. There is some significance of insurance in providing certain economic development towards the country. Now, what are the significant role that an insurance plays in the country is it provides safety and security for the insured. See, if there was no insurance, there was no financial support that you would get for your uncertainties or for your life. So there is always that fear of sudden loss. There is always a fear of loss. So this insurance companies or this insurance as a function provides you safety and security for your life and property. Not only that, it generates financial resources of the economy. See, I told you, you can use it as an investment option. So insurance companies collect premiums from the insured and invest them in government bonds or government securities, right? Where these funds will be used for the industrial development of the country, which helps in generating more funds or which helps in economic development of the country. Not only that, it also promotes something called as economic growth. Insurance has a great impact on the economic development of a country, right? Insurance helps in a country's economic development. Insurance is something which supports medical expenses of a person. There's something called as health insurance. In health insurance, you are not only insuring your what you're not only ensuring your life and property, but you are also ensuring your health. So if any critical illness happens all of a sudden unexpectedly, medical insurance policies help you in taking care of your medical expenses. They will support your medical expenses. So that is one of the important importance of insurance. And distribution of risk. Insurance also helps you in distributing your risk. It is not one person who is taking up all the risk. The insurance company is also not taking the entire risk upon themselves. They're spreading it among the large number of people. So because a large number of people buy insurance policies and pay premium, loss does not happen to every policy holder, right? Loss occurs only to very few, and that loss is covered from all the policy holders. So it is a risk management technique in which risk is shared among a group of individuals. Now, when we are talking about the history of insurance, insurance is very deep rooted in India. Insurance is mentioned under various mythological books, right? It is mentioned in Kautalya's Arthashastra and things like that. So, whenever you're talking about evolution of insurance in India, in 1818, Oriental life insurance was started to meet the needs of European community because we were in the clutches of the East India Company, right? Insurance started in 1888. In 1870, Bombay Mutual Life Insurance Society became the first Indian insurer, right? But after that, many insurance companies were founded. But in the year 1912, Life Insurance Companies Act and Provident Fund Act was passed in the Legislative Assembly in order to regulate the insurance business, which led to the rise of National Insurance Company also in the year 1906, which is still in the business. But on January 19th, 1956, the government of India has issued an ordinance stating that life insurance sector and Life Insurance Corporation of India will come into existence in the same year by nationalizing it. Right? Nationalizing is majority of the stake is held by the central or state government. Then there were 154 Indian, 16 non-Indian insurance, and 75 provident fund societies in that time. All of them were absorbed by Life Insurance Corporation of India. right? And in 1972, the general insurance business was also nationalized in Indian Parliament, right? Which came into effect on 1st of January 1973, which amalgamated 107 non-life insurance companies also into it by forming four major companies called as National Insurance Company, New India Assurance Company, Oriental Insurance Company, and United Insurance Company. These were the four major companies, right, which were formed when insurance evolved in India. Now, when we are talking about the characteristic features of insurance, insurance is something which gives you protection against your life, property, or materials. It is a device, it is a tool which is used to share or transfer the risk to somebody else. Now, the second characteristic feature of insurance is it is risk sharing. Insurance is a device which helps you to share the burden of risk, right, on happening of an unforeseen situation to another person or to a group of people. So insurance is a plan which spreads the risk of life, property, and materials to others. It is a cooperative device, that is, it helps in transferring the risk, it helps in cooperating the risk among a group of individuals or large of people facing the same kind of risk are protected under insurance. And large number of insured people are involved against the similar risk. That is, this will help to protect a large number of people. Evaluation of risk is done. That is based on what age you are, what factors of health are taken into consideration. The risk is evaluated, and accordingly, an insurance contract is designed for making the insurance payment. Not only that, one second. Yes, evaluation of risk is one thing. You can evaluate the risk, right? By evaluating the risk, you can design your insurance contract and you can pay your insurance premium accordingly. Not only that, it will help you in transferring of risk, which is one of the important thing. You can transfer the risk from yours to a group of individuals. It will help you to indemnify your happening of a specified event. That is, it will protect you against all costs, all kinds of losses. It is a social device. It works for the welfare and protection of people at large, and it is based on mutual goodwill. Insurance is a contract which is based on good faith. That is, utmost good faith is the major principle on which the insurance contracts work. Now, whenever we are talking about insurance, there are two types of insurance or which are broadly classified into. One we call as life insurance, and the other one is called as non-life insurance or general insurance. Whenever we are talking about the life insurance is a contract that offers claim or that offers compensation only in case of death of a person, right? There are some life insurance contracts which have some retirement plans included into it. There are some life insurance contracts which have maturity plans included into it. But majorly, if you're talking about a life insurance contract, they are the contracts which give you financial compensation only after the death of a person. Now, when you are receiving the claim can either be received in lump sum, or the claim can be received in periodic payments based upon the terms and conditions which the insurer or insured agreed at the time of preparing the policies. But in order to receive the claim, or in order Sorry, there was some technical issue. So whenever we are talking about a life insurance contract, it is very important to remember that this life insurance benefits will be only provided when premiums are paid on time, when premiums are when premiums are paid on time, only then you can avail the benefit, or only then you can avail the advantages of a life insurance contract. So payment of premiums is done according to the terms and conditions of the contract, but that has been entered by the insurer and insured at the time of entering into the contract. But life insurance contracts come with a wide range of services. That is, they give you protection against death benefit. They give you return for your investment. You can get tax benefits. You can avail loan facilities. There can be a guaranteed income after the death of a person, right? It gives you additional coverages, right? It promotes a habit of saving among the insurance holders, and it also helps you in retirement planning. But it also comes with a lot of disadvantages also, like it can for if you have to take up an insurance policy, you have to forgo your current consumption. That is, you have to satisfy only few of your needs currently in order to pay the policy premiums. And if you want to surrender your policy before the maturity date, or if you want to surrender your policy in between, the surrender values are very very less when it comes to insurance policy. And the insurance process is very perplexing. That is, it is the insurance agent is not always trustworthy. And buying up an insurance policy or an insurance products for age old people is very expensive, because once a person crosses 40, and he has a medical history or bad medical conditions, that person becomes a risky buyer. So in order to transfer his risk, or in order to mitigate his risk, the insurance companies charge a very high rate of premium. And the returns on life insurance are not significant, because you will not receive the benefit, your beneficiary will receive the benefits. But when you compare it with other investment opportunities like mutual funds, or putting into a systematic investment plans, they will fetch you much more returns when you compare them with the uh, life insurance policies. Not only that, insurers may not pay the benefit. Sometimes there are some hidden clauses, there are some hidden charges which will reduce your payment options. Not only that, there are certain complexity in policies. Framing up an insurance policy is not that easy task when it comes to India. Now, there are different types of life insurance policies. You have something called as term life insurance policy, endowment policy, unit linked insurance policies. You have something called as whole life insurance. You have something called as money back policy, retirement plan policy. You have children policies and things like that. Now, what happens in term life insurance policy is you take up an insurance policy for a specific time period, right? That is the reason it is called as term life insurance policy. This kind of policies are taken only for life protection. They don't give you anything in return. That is, during this policy period, if something happens to the insured, only then they pay the sum of the insurance. If not, they will not pay you anything. This kind of policies are called as pure life policies. Endowment policy is a policy in which a portion of your premium goes to death benefit, and the remaining portion is invested in some investment opportunities. So they give you something called as maturity benefit, death benefit, periodic bonuses also, right? Apart from that, they invest your sum somewhere, so they give you additional benefits also. So the premiums are comparatively high when you compare them with term insurance policy. Unit linked insurance policies are similar to endowment policy, but a part of premium that is going in investment option will only go towards mutual fund investments only. That, whereas in endowment policy, it can be invested in any investment avenue. Whereas in unit linked insurance policies, it is invested only in mutual funds as unit linked insurance policies. So mutual funds only. So some portion goes to death benefit, some portion goes to mutual funds. That's the reason it is also called as market linked insurance policies. Under whole life insurance policy, the entire life of an individual is covered. It is not a specific time period, right? The tenure can go up to 100 years also. There are something called as children's policy. The benefit will be paid only to the child or the children of the insured, right? This policy's benefit are paid in lump sum amount after the death of the parents. There's something called as money back policy. Such policies give a certain portion of premium back to the individuals in case of their survival. This benefit is also called as survival benefit. There is something called as retirement plan also. This is a plan. This is like a pension plan which provides claim to the policy holder after the retirement. Either a lump sum or a periodic payment of annuities is done to the policy holder after he retires from his work. And there's something called as group insurance policy. If you don't want to take up an insurance policy on each individually, you can go for a group life insurance policy in which you are protecting the life of a group instead of an individual. It can be group containing the family members, or it can be group containing colleagues or workplace members. Employees is what we call upon. You can take up a group insurance policy for them. Apart from that, we have something called as non-life insurance also. Anything which does not protect the life of a person, or any insurance policy which gives you financial compensation other than death, we call such kind of insurance policies and non-life insurance policies. This non-life insurance policies are also called as general insurance policies, because in this you can cover insurance for what do you call as automobile, marine, fire, what do you call as medical insurances also. So whenever you're talking about the benefits of non-life insurance policies, it indemnifies all your losses except your death, right? They help you in managing cash flow uncertainties. They help you in efficient use of resources. They support the insurer's credit, right? They act as a source of investment opportunities. They give you tax benefits. But there are some disadvantages also. Mostly, generally, the non-life insurance policies contain a lot of tricky terms and conditions which we have to take into consideration. I think all of you might have heard about the act of God. So all the clauses must be read properly before signing up on non-life insurance policy. Not only that, there are a lengthy legal formalities involved if you want to go for a good life insurance policy. So in insurance policies, it is very, very important to understand that these insurance policies have a very legal formalities which you need to take care of. And there are some potential crime incidents also. If something goes wrong, you can never get your insurance amount. Now, what are the various types of non-life insurance policies are? First is fire insurance. This insurance gives you protection against any damages that are caused by fire or other fire related issues. So this is basically a contract between a buyer and insurer, wherein the insurer will pay you the sum of insured only if a damage is caused to your property, or only if a damage is caused to your assets by fire only, right? Usually, all the non-life insurance policies are for 1 year only, and you can renew it after every year. So this safeguards your assets or properties from any kind of fire-related accidents or events. Marine insurance covers the losses, damages of ships, cargoes, and terminals, or any transport of cargo by which property transferred, property relating to ship related issues is caused damage. Such kind of damages are protected against marine insurance, right? It protects both onshore, offshore properties, right? Cargoes, everything. Anything, any damage that is caused to vessels, cargoes, single time, multiple times in a year, or anything that happens, anything related to marine or ship related issues, marine insurance will take care of. Health insurance is also an insurance which covers the medical expenses of a policyholder. If he or his family falls ill and any medical assistance is needed, they take care of all your medical expenses. Girls, sorry, whenever we are talking about health insurance covers all your medical expenses. It will not cover your death, but it will cover all your medical expenses. So any disease specific plans you can take up. You can take up any general health insurance policies in order to protect your family from any kind of medical expenses. Apart from that, you can get household insurance also. You can get household insurance in order to protect your household things like structure of your house, contents of your house. You can protect your houses from earthquake, floods, storms, cyclones, fire, theft, riots, right? You can uh, take insurance for your properties, valuables, and things like that. Apart from that, there are other types of insurances like motor insurance, travel insurance, general liability insurance, cyber risk insurance, loss of insurance, everything. See, whenever we are talking about motor insurance, if you are protecting your assets, your automobiles, we are talking about motor insurance. If you're traveling something and you want to protect your life or you want to protect your medical expenses in the other place, you can take up a travel insurance. If you have a liability, if you have some credit, you can protect that. You can protect that liability also by taking general liability insurance. If you are prone to any kind of cyber risk, you can take up cyber risk insurance also, and professional indemnity insurance can also be taken if required. And one of the last type of insurance is rural insurance, right? Rural insurance is an insurance which is taken for the families living in rural areas in order to have a safe and secure future so that they can lead their future life happily, right? This insurance covers risk associated with various aspects of their life, right? Like hut insurances, poultry insurances, sericulture insurances, honeybee insurances, right? There are a lot of companies which provide such kind of insurances like Tata AIG, Cholamandalam, Oriental Insurance. All these are the insurance companies which are coming up with rural insurance. If these rural working conditions are not operating properly, then they can claim that insurance amount. And another important insurance which is gaining importance these days is social insurance, right? Where government is intervening into the insurance market to make sure that a group of individuals are insured, right? Or protected against any kind of emergencies, right? Here we have schemes like Employees Provident Fund scheme, Employee Pension Fund scheme, Employee Deposit Link scheme, Pradhan Mantri Rozgar Yojana, right? Rajiv Gandhi Yojana, Mahatma Gandhi National Rural Development Guarantee Program. All these are the insurance schemes which are provided under social insurance. So whenever you're talking about general insurance, anything which covers your other expenses other than death comes under general insurance. So there are two types: life insurance, which only gives you protection against life. General insurance is an insurance which gives you protection against anything apart from life, right? That's all for today. Meet you in the next class.